Okay students, I'm back and this is the second video for chapter 1 and we're going to talk about how transactions affect the accounting equation. A transaction is simply an economic event that changes the financial position of a company. And what we're going to do today is set up an imaginary business, and we're going to do a photography business because that is a service organization and it will be owned by one person. Okay? So the very first thing I need to do if I'm going to set up this photography business, I need to put in some money. And what I've done here at the top, before we even start the transactions, I have put the accounting equation back in and I have expanded it to show the pluses and minuses that we talked about in the first video. So I'm going to put some money in now, and I'm going to say I'm going to put in about, probably about 20,000. So I'm going to have a plus here under cash. And what we're going to do here is show how all of these transactions affect the accounting equation. And there's one thing you need to know about a transaction is that there are always two sides. Okay? So if I put money into the business, I'm giving the business $20,000. But I also have equity in that $20,000 or in the business. So I'm going to go over here and put plus $20,000 under capital. Now you can see even at this point that the accounting equation is still in balance, and it must always be in balance. Okay? Alright, now that I have some money, I'm going to buy some equipment because I need some photography equipment. So I'm going to say I'm going to buy about maybe $10,000 worth of equipment. However, since I only put $20,000 in, I don't want to use that money, so I go out and purchase the equipment on account, or I charge it, and we call that accounts payable. So I do get the equipment for $10,000, but also I have a liability. I have to pay it back, an obligation to pay it back for $10,000. Okay? I'm going to draw an imaginary line here. Well, it's not imaginary, but that way we can keep the two sides of the equation separate. Alright, we still have the accounting equation is in balance. Now I'm not going to put the balances in on this chart like you have in your textbook simply because I don't have the room. But in your textbook and in your problems you need to put a balance after every transaction. But what we have here, we have $20,000 in cash, we have $10,000 in equipment, we have $10,000 in accounts payable and $20,000 in capital. So you can see that both sides do equal because you would have $30,000 on each side. Okay, now that I have some equipment, I probably need some supplies, so I'm going to purchase about $5,000 in supplies. It may seem like a lot, but I'm trying to keep the numbers round so it makes it easier. And I'm not going to charge that because I'm going to spend my cash for that. So I'm going to say let's pay for the supplies in cash, which means I'm decreasing my cash. Now we still see that the accounting equation is in balance. You've got 30,000 here and 30,000 here, but something happened that's different this time than before, because before we had something happening on both sides of the equation, whereas here both sides of the transaction were on the same side, and that's okay because what we did here was decrease one asset and increase the other asset, but we're still in balance. All right. Now I need a location, so I'm going to go out and rent a studio or some type of building or a room in a building. Let's say the rent is for a month is about $1,000. So I'm going to say I'm going to spend that money. That's $1,000. Again, these numbers don't have to be anywhere near correct. I'm just coming up with round numbers. I am making this up as I go. Alright, so now that's going to be an expense. That's my first expense, okay? Because I have to have expense in order to generate revenue. So I have $1,000 here. I'm going to come over here and put that under expense. But remember, we subtracted expense from owner's equity, so that's going to be a minus here. Okay? Also, when I go out and make pictures, I need somebody to stay in the office to answer the phone, so I'm going to hire a receptionist for $2,000 a month. I'm going to pay her up front. Okay? And that's also going to be an expense. That'll be a salary expense, so that's going to go over here as well. Decrease cash and add that to our expenses over here, which decreases owner's equity. Okay, now I go out and take some pictures and I make some money. So I take in, let's say, $10,000. Okay? I take that in cash, but now that's revenue. So I'm going to go over here and put this under revenue. And remember, revenue is a plus to owner's equity, so we add it over there. And then I get to the end of the month. This is my first month of operation. I get to the end of the month and I realize that I've used some of my supplies. I don't have $5,000 in supplies anymore. I check my supplies and I only have $4,000, which means I've used $1,000 in supplies. So, if we don't have $5,000 in supplies, we don't have $5,000 in an asset. We only have $4,000. So we need to take that off of the asset. And anytime we use up an asset, as we do with expense or with supplies, then we're going to charge it to expense. So this will be a decrease to the asset, and over here we're going to add it to our expenses. Remember, expenses is a minus to owner's equity, so we will subtract it. Okay? Alright, now one other thing I need to do before we finish this scenario, and that is show you how an owner will take money out of the business. We talked about that in the first video, that the owner has to take money out in order to survive and pay their own house payment or rent for themselves. So the owner can take money out. Let's say the owner has decided to take out $2,000 per month. So we're going to take out $2,000 here in cash. And over here we're going to add it to withdrawals. And remember, withdrawals is a minus. Alright. Now, what I'm going to do is see if we can come up with some totals here. And I'm not real good at drawing straight lines, so just know that. Let's see how much we have in cash. We got 20 plus 10, that's 30, minus 5, that's 25, 24, 22, 21, 19 in cash. Now I'm just hoping, I'm making this up as I go, so I hope it comes out. If it doesn't, we'll figure out why. We have $10,000 in equipment, and we have now $4,000 in supplies. So if we add those numbers up, we have $19,000, $29,000, $33,000 total. Okay, what do we have on the other side? We have $10,000 in liabilities plus $20,000 in capital plus $10,000 in revenue minus $4,000 in expenses and minus $2,000 in withdrawals. Now let's see if that comes out to what it should. 10, 20, 30, 40 minus 6 is 34. I'm off. 10, 20, 30 thousand minus 4 is 36. Minus 2 is 34. So I've made a mistake probably on the other side. Okay, let's take a look at it. 20,000 minus 5 is 15, 14, 12, 22, 18. 20. So this is 20. Alright, now if I add 20, 10, and 4, I do get the 34,000. It's okay to make mistakes, that's how you learn. And certainly when I make something up, I never know how it's going to come out. So what we have here is 34,000 on this side and 34,000 on this side. And every transaction does affect the accounting equation. What we're going to do in the next video is talk about how this information would go into financial statements. So I will show you how to put together the financial statements, which are prepared at the end of a period, either the end of the month, the end of the quarter, or end of a year. But that's all for now. Thank you.